Hello, and welcome to ENN, the Economics News Network. I'm Liam Gritters, and this is our top story today: the downturn of the Canadian dollar and the effect it has on consumers. We have Craig Alexander with us to discuss this topic. But first, let's talk about these past couple of months and the decrease that has occurred in the loonie. The Canadian dollar has had a sharp slide since the beginning of 2014. We haven't seen this bad of a start in 4 decades, and most predictions are that it will go lower. A steep fall on Wednesday took it down 9/10 of a cent to 88.93 US. The loonie was last below 89 cents in May 2009. It has lost 4% in the value since the beginning of the year. The value of the Canadian dollar, like any commodity, rises and falls in response to the forces of supply and demand. Everyone needs to spend, and consumer spending directly affects the money supply, and vice versa. The supply and demand of a country's money is reflected in its foreign exchange rate. When a country's economy falters, consumer spending declines and trading sentiment for its currency turns sour, leading to a decline in the country's currency against other countries with stronger economies. In this case, the Canadian dollar compared to the American dollar, or, alternatively, the strength of the Canadian economy versus the American economy. The value of currency is affected by 5 factors, the first being interest rates, which is a rate set by the central bank which influences the retail rates financial institutions charge customers to borrow money. For instance, if the economy is underperforming, central banks may lower interest rates to make it cheaper to borrow. This often boosts consumer spending, which may help expand the economy. Interest rates are of particular concern to investors seeking a balance between yield returns and safety of funds. When interest rates go up, so do yields for assets denominated in that currency. This leads to increased demand by investors and causes an increase in the value of the currency in question. The second factor is unemployment. An increase in unemployment signals a slowdown in the economy and a possible devaluation of a country's currency because of declining confidence and lower demand. If demand continues to decline, the currency supply builds and further exchange rate depreciation is likely. Thirdly, are economic growth expectations. Most countries target economic growth at a rate of about 2% per year. With higher growth comes higher inflation, and in this situation, central banks typically raise interest rates to increase the cost of borrowing in an attempt to slow spending within the economy. A change in interest rates may signal a change in currency rates. Next is trade balance. A country's balance of trade is the total value of its exports minus the total value of its imports. If the number is positive, the country is said to have a favorable balance of trade. If the difference is negative, the country has a trade gap or trade deficit. Trade balance impacts supply and demand for a currency. When a country has a trade surplus, demand for its currency increases because their foreign buyers must exchange more of their home currency in order to buy its goods. A trade deficit, on the other hand, increases the supply of a country's currency and could lead to a devaluation if supply greatly exceeds demand. And lastly is central bank actions, or also called monetary policy. Quantitative easing is being used to increase the money supply within an economy. It involves the purchase of government bonds and other assets from financial institutions to provide the banking system with additional liquidity. Quantitative easing is considered a last resort when the more typical response, lowering interest rates, fails to boost the economy. It comes with some risk. Increasing the supply of a currency could result in a devaluation of the currency. In the most recent event of the downturn in the Canadian dollar, it is speculated that the decrease was caused by earlier remarks by Fed Chair Janet Yellen on Wednesday that were interpreted by investors to mean that American interest rates could be headed higher earlier than they had thought. The Fed's previous guidance had been that the federal funds rate would remain at its current low level of 0 to 0.25% for a considerable time after it ended its monthly bond buying program. Yellen defined the considerable time at 6 months or more in her news conference Wednesday. That would put higher rates on the table by mid-2015, a prospect that drove up U.S. bond yields and attracted investors to the U.S. dollar. In Canada, the prospect of rising rates seems more distant. Bank of Canada Governor Stephen Poloz has even talked about lowering rates. That makes the loonie and Canadian bonds less attractive to investors and thusly decreasing currency value. We are here with Craig Alexander, Chief Economist of TD Bank Group, to further discuss what has been happening.
Really, what's happened is that the Bank of Canada changed market expectations around the timing of interest rate hikes. The Bank of Canada, for a very long time, had a bias towards the next move in interest rates being higher. When they came out with communiques, they said that at some point all the stimulus that had been provided would have to be reduced. And they dropped that language back in October. And when that happened, financial markets rethought how the Bank of Canada is likely to conduct monetary policy, because by signaling before that the next move in rates was up, it meant that there was only one direction to go. The minute they dropped the bias and said, well, we think the risks are balanced, then markets started to think about, well, wait a second, rates could actually come down, and that weakened the Canadian dollar.
Devaluation is both good and bad depending on your place in the economy. The hospitality and tourist sectors, exporters, and particularly manufacturers, which have been losing market share in the world, are among the major winners. So are the people who work in these industries. On the other hand, a weak dollar could stoke inflation, making life more expensive for consumers, travelers, and importers. On balance, however, experts argue that an 89-cent dollar is probably closer to fair value, and therefore a good thing for corporate Canada and the broader economy. Bank of Montreal, for example, estimates that a 10% drop in the currency could add as much as 1.5 percentage points to real gross domestic product over 2 years. This is a very suitable topic for economics, or moreover, macroeconomics, because it discusses all factors of the economy and the concept of investment through international trade. Currency is a trade barrier and could be positive or negative on a country's economy depending on the factors that I listed earlier. Furthermore, currency value gives an indication to economic strength of each country based off of the American dollar, which is the baseline and most commonly traded currency. Low currency is not necessarily a bad thing and can be very positive in other countries like China and other parts of Asia, which have high export to import ratios. The issue of low currency value can be fixed with the use of increasing interest rates and attracting investors, or by using other monetary policies. Additionally, the possibility of the American dollar lowering, as it was witnessed during the recession, can increase the currency of another country. Thank you for listening to this segment of ENN with me, your host, Liam Gritters. I hope everyone learned something new, and I'm glad I'm able to keep you up to date on your economic news. Have a good night.